So firstly, let's visit the definition of bad debt. Bad debt is any credit advanced by any lender to a debtor that shows no promise of ever being collected, either particularly or in full. Any lender can have bad debt on their books, whether they are a bank or other financial institution, a supplier or a vendor. In another word, the bad debt is a cash that you know a client or customer is not going to pay. It represents the outstanding balance of a company that are believed to be uncollectible. So why a bad debt can occur? The first reason is the debitor may have passed away, and the second reason is the debitor may have become bankrupt. Third one is the debitor may have disappeared and it cannot be connected. And the first is the debitor simply cannot afford to pay the debt. So for the double entrance for bad debt, we can see the bad debt account needs to be recorded on the debit side because bad debt are an expenses. It reflects the cost of expected credit losses. For the credit side, we need to record as respective accounts receivable. And the reason for we recorded the credit side because the respective account receivable is to remove the debt.
First statement, add new bad debt with previous bad debt. For the first statement, we need to add the amount of bad debt that been given in additional information with the previous amount of bad debt in trial balance. In this question, the amount of bad debt in additional information is 6,000, need to be added with previous amount in trial balance, that's 1,000. So 6,000 plus 1,000 equals 7,000, that the new amount of bad debt or the current amount of bad debt. Second treatment, state in statement of profit or loss and other comprehensive income under the expenses. Okay, after we calculate the new amount of bad debt, we will move for the second treatment that we need to state the new amount of bad debt in statement of profit or loss and other comprehensive income under the expenses. So in this question, we will put the 7,000 that we calculate in statement of profit or loss and other comprehensive income under the expenses. For the third treatment, deduct with account receivable to get the net account receivable in statement of financial position under current asset. Okay, the next treatment, the amount of bad debt in additional information need to be deducted with account receivable to get the net account receivable in statement of financial position under the current asset. In this question, we need to deduct 6,000 with amount of account receivable 20,000 to get the net amount of account receivable. So 20,000 minus with 6,000 equal to 40,000. The 40,000 is the net amount of account receivable that we need to state in statement of financial position under the current asset.
Now, let's have a look at next subtopic, which is doubtful debt. Doubtful debt is a cash that you will predict it will turn into bad debt in the future. It is not officially become a bad debt yet, and there is still a chance to reclaiming the lost money. It is known as allowance for doubtful debts or provision for doubtful debts because it refers to the portion of a business account receivable that unlikely to be collected in the future. It is the money from credit sales to the debtors that a business does not expect to receive. These are the double entries for recording allowance for doubtful debt. There are three situations where in situation A is for the first time a business creating provisions for doubtful debt. There are no previous year balances, so we have to debit statement of profit or loss and other comprehensive income and credit allowance for doubtful debt. For situation B, it using the same concept as A, but this is when the current provision that we calculated is higher than the previous balances. For C, it shows opposite concept, where we have to debit allowance for doubtful debts and credit statement of profit or loss and other comprehensive income. This is because the new provision is lower or showing decreased trend from the balances in trial balance. These are the ledgers for the journal just now.
Now I'll briefly explain the question. Based on the additional information number 8 given, the allowance for doubtful debt is 1812, which is followed by the first treatment. On the classification part, which is treatment 2, there is an increase in allowance for doubtful debts. This shows the higher probability that doubtful debts might turn into a bad debt. So, it will be stated under expenses in the statement of profit or loss and other comprehensive income. Followed by the third treatment, we should deduct the allowance for doubtful debt with account receivable, as it is considered as contra asset, which reduces the amount of asset.
For the revenue example, let's say if the new provision for doubtful debts is 1,788 ringgit, where it shows the new provision is lower than the previous balances, which is 1,800 ringgit. It decreased by 12 ringgit, so in the statement of profit or loss and other comprehensive income, we recognize the changes of 12 ringgit is our revenue or other income. Meanwhile, in the statement of financial position, we have to minus account receivable by the new calculated provision, which is 1,788 ringgit, to get the net amount of account receivable, which is 34,452 ringgit.
So now let's see the findings between bad debt and doubtful debt. The bad debt amount to that portion of the doubtful debt which are either irrecoverable or whose probability of recovery is very rare. Doubtful debt is a debit whose recovery is not certain, may or may not be received. In other words, this means that doubtful bad debt is a part of account receivable, but it cannot be collected, or the probability to recovery is very low.
Next, bad debt refers to the amount which a customer owes to the firm whose likelihood of recovery is remote, as it turns out as irrecoverable. So, bad debt is an actual loss. On the other hand, doubtful debt implies the amount which customer owes to the firm, but whether they will be receivable or not cannot be ascertained on the date of preparing the financial statement. This shows the doubtful debts considered as an anticipated loss.
Bad debt as a specific debtor account. So as we know, bad debt is a specific debtor account that we can detect which debtor cannot afford to pay the debt. Well, doubtful debt is a percentage of provision for all the debtor account. In doubtful debt, we know that doubtful debt is the prediction for all the debtor account to know how many debtors cannot afford to pay their debt.